Now that you've had a chance to work through problem 1-7b at the end of the chapter and review the solutions also posted to Blackboard, if you still have any questions, you're probably watching this video. So I'll go ahead and use this time to address some of the more confusing items in this problem. This is problem 1-7b, and I'll start with parts 1 and 2. For part 1, you're asked to create an accounting equation with all of the accounts that this particular company will be using. So you'll have your assets, liabilities, and equity, and then little subdivisions for each account that this company has needed based on its transactions. You start with the first item, June 1st. The company has the following transaction. Owner, Benton, invests $41,000 cash in the company in exchange for common stock. Now you've seen this example probably ad nauseum already in the slides and in the homework. And when an owner invests cash, the company experiences an increase in cash, and they experience also an increase in equity under common stock. And again, if this is a little hard to see, please know that these solution files are posted to Blackboard for more easy reference. June 2nd, there tends to be a little bit of confusion. The company rents a furnished office space and pays $2,200 cash. A lot of times students want to show that office is some sort of asset, but because they're renting it, it's actually going to be an expense. So it's an expense, and there is a decrease in cash. Now remember, we want to make sure after each transaction that our accounting equation is in balance. So for example, after the first transaction, we had a positive $41,000 on each side of the equation, so we were in balance. And on June 2nd, we have a negative $2,200 on each side of the equation, so we're still in balance. On June 6th, I'm going to go ahead and skip the 4th and go to June 6th. The company pays $780 cash for advertising for the opening of their business. So advertising, that's considered a normal business expense. So it'll show up under business expenses, and they paid cash for that. Let's go ahead and go on down to the 20th of the month. This one tends to be a little confusing. The company receives $2,400 cash payment for services completed earlier in the month. So earlier in the month, we completed services for a customer. They weren't able to pay us right away. They were going to pay us later. That's the definition of an account to be received, money that we're owed. So we increased accounts receivable, rightly so, by $2,400, and we recognized the revenue that we earned on that day, even though cash wasn't received. Because again, that's the basis of accrual-based accounting. Recognizing revenue when earned, not when received in cash. So we properly recognized revenue on that day. Now, on the 20th, when we actually receive the cash, we show an increase in cash. And what you're going to want to do is decrease the account receivable, because now this customer has paid you. So they owe you, they have no further balance that they owe you after that day. So $2,400 positive minus $2,400 negative shows that they have fully paid off their account. A lot of times I see students wanting to touch revenue on the 20th when they get that cash payment. Remember, you only touch revenue once when you earn it, which in this case was a few days earlier on the 14th. See, on the 25th, very similar situation. We receive cash for payment on a customer account. So pretty much the same thing. Remember, we're not touching revenue on that day. You touch it the day before when you actually earned it. On the 26th, the company pays off an account payable for equipment that was previously purchased in the month. We had previously purchased some equipment on account, so we increased the asset, increased the liability, and then when we finally pay it off, we're going to go ahead and decrease the liability. Notice we don't touch the asset. We only touch the asset once when you purchase it. Alright, but we're not going to touch it again. On the 26th, the only thing affected is a decrease to cash and a decrease to accounts payable, because now we've fully paid off that account. And I believe that was the last of the trouble items. Just make sure that after each transaction you make sure your accounting equation is still in balance. And then go ahead and sum up your figures at the bottom and do your check. Make sure that the sum of your assets equal the sum of your liabilities and owner's equity. And we'll go ahead and start part 3 in just a minute.